Hi, I am Dan the Finance Man and welcome to my channel. Today I want to tell you about the 6 investing mistakes that can cost people millions. So over the years I've spoken with so many clients who made investment decisions that seemed smart at the time but ended up quietly eroding their wealth. One case that's particularly relevant for most UK expats that I talk to is a decision that over decades left someone far worse off than they realised. This investor wanted a safe place to put their money in the early 1990s, so they put £50,000 into UK premium bonds, thinking they were a great way to grow, they're UK government backed, so essentially no risk, tax-free prizes, so go wrong. If you fast forward to today, that £50,000 still sits there. They've won the occasional small prize here and there, but if they'd simply kept pace with inflation, they'd need over £115,000 to have the same spending power. Instead, their money has quietly lost value, so just think about this for a moment. What they could buy 30 years ago for £50,000 would now cost them £115,000, yet they still only have £50,000. So effectively, they've lost £65,000 over 30 years when you adjust for inflation. I will be releasing a separate entire video dedicated to premium bonds in the coming weeks and why I think the only people that may be worthwhile for are UK residents earning over, say, £160,000 a year. Personally, I don't think anyone else it's worthwhile for, so subscribe to the channel and when I release that video, you'll get a notification. But coming back to the bigger picture, this is just one example of an investment that appears much better than it actually is. It's largely due to smart marketing by NS&I and general lack of understanding of the numbers and basic economics to do with the investments. So the purpose of this video isn't to tell people they've been foolish. On the contrary, it's to highlight mistakes I've seen so many clients make before I met them. So listen and learn from their mistakes so you don't have to make them yourself. So without further ado, here are my top 6 mistakes to avoid. First and foremost, buying the dip. So we've all heard it, buy the dip. The idea is simple. When the market drops, it's an opportunity to get in at a discount. So that's when you buy. But the problem is, what if the dip keeps dipping? Or what if you're so convinced that prices will fall further that you never actually invest? Time in the market is dangerous. It's not something many investors can do. Most miss out on long-term growth while waiting for the perfect entry point. There are some eye-opening stats around the impact of missing key trading days. For example, over the last 30 years, if you miss just the top 10 days of market returns, your entire portfolio would be cut by around 50%. And that may not sound that big, but here's the thing. Over 75% of those best days happen during bear markets when asset values are falling. So what people would call the dip. So you're probably going to get caught out by it. So what's the solution? Have a plan, understand your investment time horizon, and invest consistently, not based on short-term market swings. My second tip, second mistake, or second thing to consider is that cost is king. Most investors focus on returns, but the reality is that one well-diversified portfolio will perform similarly to another based on overall market movements. You can't control that, and very few people or organizations can accurately predict the market consistently. One thing you can control is costs, and costs eat away at your wealth faster than you think. Whether it's fund fees, transactions, or hidden charges, every percentage point lost compounds over decades. Research shows that most actively managed funds fail to beat the market after fees. So keeping costs low isn't just a strategy, it's a necessity. That being said, there are many reasons why paying for a financial advisor makes sense. So unless you're dedicating at least 10 hours a week to your personal investment strategy and doing it yourself, a good financial advisor will almost certainly save you more than they cost. Again, I'll be releasing a video on that separately, so hit subscribe to get notified when that's out. Third point, you know what you know. The market knows what everyone knows, and it's something that people don't realize. So something I hear all the time is, with everything happening in the world, I know this stock will take off, or this sector is bound to crash because of the economy. Things like this are some things I hear all the time. But the thing is, if it's in the news, the market already knows. So prices already reflect what the public already knows, i.e. the public information. So unless you truly have unique insights, which let's be honest would probably be insider trading, which is illegal, you don't have an edge. So what I'm trying to get at is that markets price in information instantly. So a stock's value already reflects the news you're hearing. So it's unlikely that you're going to have this extra bit of knowledge. My next mistake or tip is fads will fail, consistency will prevail. What I mean by that is every few years there's a new hot investment, whether it's tech stocks, crypto, AI, whatever the next big thing is. People rush in, convinced that they're ahead of the curve, but most end up buying at the peak. And there's only one way to go after that, and that's down. So remember, for instance, the dot-com bubble, the crash that followed. That's what I'm talking about. Timing trends is tough, and history shows that chasing what's popular rarely pays. Fifth, if it seems too good to be true, it probably is. So you may hear about a guaranteed high return with no risk, or a secret investing strategy paying 15% per year that never loses. These things don't exist. They ultimately fail. And what you need to do is ask yourself, if a company could guarantee a high return, why would they offer it to you instead of taking it for themselves? They aren't in the business of making you rich. They're in the business of making money off you, and you do have to bear that in mind. So this is another huge reason that a good regulated financial advisor adds value. They'll spot the sales tactics and unrealistic claims before you get sucked in. And if you don't have an advisor, always question the pitch. There's got to be a motivation or a reason behind it. Final thing to remember is that you should invest, don't gamble. So a proper investment generates value. It produces goods, services, or cash flow. For instance, property generates rental income. Stocks and shares provide dividends. Bonds pay out a return and give you back your initial investment. All of these are proper investments. But speculation, it's just betting on prices going up without any real value being created. I'm not saying speculation can't be lucrative. Look at Bitcoin, it's been amazing for people over the last 10 years. But you have to recognize that speculative assets have no intrinsic value or guarantees. So only speculate with what you can afford to lose. So they're my 6 investing mistakes to avoid. I've seen these mistakes cost people fortunes, but you don't have to follow the same path. The key to investing isn't finding shortcuts. It's about being consistent and avoiding the traps, which is the most important thing. So if you found this video helpful, please hit the like button and also subscribe to the channel for more helpful insights or more helpful videos in the future. And finally, please comment, what's the biggest investing mistake you've seen and what topics would you like to see me cover in the future? I look forward to making future videos, so let's learn from each other, and I will see you in the next video. Bye-bye.